Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, if we look at the American stock market, the S&P 500, the big focal point for the next couple of days is the all-time closing high that we had back in February, just before the coronavirus sell-off. So that figure was 3386, and in the last 24 hours we actually broke above that level on the S&P 500, but then dipped back below it for the close. Now, closing prices are always more important than the intraday moves because that's the final price at the end of the day and it shows a definite pattern that's going on. So you want to look at where the market closes, where the conviction is at the end of the day. So will we get that all-time high close in the next few days? The odds are that we probably will, because of course we've seen it in the NASDAQ already in the US. So it always felt like the S&P 500 was playing catch up. Now, if we don't, then you're going to start hearing stories about double tops, which is a technical sign where if the market hits a level, retests it, so it hits a level, falls, retests that at a later date, and then fails again, then that double top can be a sign that the market is about to roll over. So that would be something that the bears out there would love to see, given that most of them will have missed out on this rally that we've had since the lows in March. Now, we've seen a lot of changes in markets actually in the last few weeks and probably the last 2 months, to be honest. There's been a lot of momentum driving the market. So if you recall last week, I said that if you owned tech stocks, if you owned government bonds, particularly in the US and the UK, and if you owned gold, then you've been doing very well indeed with a relatively low exposure to equities within your portfolio. But I then mentioned that the trend is your friend until it's not. And this week we saw that play out. In fact, we saw almost a complete reversal of all those momentum trades. And we saw bonds sell off quite aggressively. We saw gold sell off very aggressively. It fell 5% in a single day after hitting about $2,070 per ounce. And it fell around 5% in one particular day and within a 24-hour period. And then we've seen it now stabilize around $1,945 per ounce. So it'll be interesting to see whether gold now manages to rebound. But gold tumbled partly because bonds were falling. So the yield on the 10-year US Treasury yield was rallying. So if the yield rallies, that means you're getting more almost income on a Treasury yield. It makes gold seem less attractive. But it was also because the market narrative started to change. It started to talk about the likelihood that we'd seen the lows of the yield on the 10-year US Treasury. So if yields on bonds aren't going to fall any lower, then it's likely that the bonds themselves, the treasuries themselves, will start to fall in value, and that would have a knock-on effect to the attractiveness of gold. It would actually make gold start to fall too. So we started to see that reversal. And don't forget, because equities are now back up towards their all-time highs in America, then the haven assets were starting to see some selling pressures as people started to pile more into equities. So we almost had a perfect storm for those momentum trades. We had gold sell-off, we had bonds sell off, and we also had the technology stocks sell off as well. So we saw the selling pressure hit the NASDAQ, and at the same time we saw the Dow Jones start to outperform. So we saw a rotation out of the tech stocks, the growth stocks, into more value plays and into the cyclical sectors. We've seen this happen once already during the rebound since March, and then it all unraveled and reversed the other way. So we've yet to see if that's going to play out, but technology stocks certainly came out under a lot of selling pressure. So if you're holding tech stocks, you would have felt a bit of pain within the last week. But then, as I say that, Tesla decided to do a stock split. So if you invest in Tesla shares, then what they've done, they've announced a stock split, a 5-to-1 stock split, which means you'd get 4 additional shares. The total market cap of Tesla will stay the same. Now, a couple of weeks ago, Apple did a similar thing with a 4-to-1 stock split. And the reason why companies might do this are numerous, but one of them historically has been it reduces the actual price of individual shares and opens up the availability or the ability for other investors to start to invest in the company because the share price starts to be, it's lower. Of course, you can now own parts of a share via the trading platforms that exist, but ultimately it's seen as a positive move for the share price. And if you looked at what happened after Apple did a stock split, their share price rallied 5% on the news. Well, Tesla, it rallied 13% yesterday. So we're seeing some positive moves today as well. So what that did is, if you go back to last week's show, I started to talk about the NASDAQ 100 and this support line of a 20-day moving average. The NASDAQ 100 started to test that line again and was looking like it was going to break through it. Now, this has just given some more fuel to the NASDAQ and the tech rally. And we saw the NASDAQ 100 bounce off that line again, and we're seeing it start to outperform in the last 24 hours. Will we see that reversal that we had in the last couple of weeks reverse again? So are we going to start seeing tech stocks start to outperform, and will it have an impact on bonds and gold? It's interesting to see what happens. The markets are at the moment whipsawing back and forth, and so for a lot of investors, they could get caught out trying to chase these trends. But we would always like to see a bit of rotation because it's good for the health of a bull market. You can't just have one sector leading the charge higher. So if we quickly look at the FTSE 100 and the UK, the FTSE 100 is back above 6,200 after it dipped below that key 6,000 level. It's still being held back by the strength of the pound versus the dollar. The dollar is still weak, and so the pound-dollar exchange rate is still around $1.30. So that's always going to hold it back a bit. We've seen European equities rebound slightly, but they're still lagging their US counterparts when you look at the year-to-date performance. And of course, throw into the mix that the UK has now officially entered recession. It perhaps surprises some people that the pound is as high as it is at the moment. Now, if we look forward to August, it will be interesting to see what happens, because August is traditionally good for UK government bonds. So we could see the yields fall on the US 10-year Treasury and the UK gilt yield, because that's also rallied in the last week or so. So we could see a move back into government debt. That'd be interesting to see whether that actually happens based on history. And also, August is normally a strong month for the dollar. And again, going back to last week's show, if we see the dollar strengthen, that could cause more wobbles for markets. So right now, it's a focus on those momentum trades. Has the market decided to reverse? Is the trend no longer your friend? Or is it a case of something we saw earlier on in the summer, just a wobble where the momentum picks back up again for tech stocks, government bonds, and for precious metals? So that is it for this week on Damien's Midweek Markets. There won't be a show next week, actually, because I'm going to have a week off. I'd like to think it's a well-earned rest. You can still contact me via email. Damien@moneytothemasses.com is the email address. Twitter, moneytothemasses with a number 2 is the email handle. Of course, you can find us on Instagram, Facebook, and don't forget to subscribe to our YouTube channel.